Dividends are perhaps the most sought passive source of income, and several individuals seek to live off of them. The primary issue with attempting to live off dividends, however, is that many individuals believe it is out of their financial reach, since they believe they need a multi-million-dollar portfolio in order to do so. And yes, it is true that a large portion of people's savings is placed in retirement accounts, which are meant to enable them to retire at age 59 or later. However, you may want some degree of financial freedom before you get too old, when health issues may prevent you from fully appreciating life's experiences. It's also possible that you want the financial freedom to leave a well-paying job in favor of one that is less demanding or requires less of your time. This is why in today's video, we will be talking about how to make $1,200 a month off dividends using a small account. And we would really appreciate it if you subscribe here on Usable Wisdom and hit the notification bell. It's completely free and you may change your mind at any time. That way, you'll be the first to know when we share new money-making ideas. So, it's a win-win, isn't it? Without further ado, let's proceed. Consider the freedom you would experience if, for instance, your dividend portfolio consistently generated enough monthly income to pay your rent or mortgage. Assuming you paid $353,000 for a medium-priced property, made a 20% down payment, and obtained a 30-year fixed mortgage at 3% interest, your monthly mortgage payments would be slightly under $1,200 or $14,400 annually. Therefore, if you could create a portfolio of safe and reliable dividend stocks that pays out that much, you could practically live without a mortgage. Through dividends with the ETFs I'm going to share, you get the same result with less money than paying off the $283,000 mortgage total in full. Everything about this sounds excellent, but we must be clear that a dividend portfolio has a different objective than a retirement account and involves a significant trade-off. When building your dividend portfolio, you should take 3 other important aspects into account. The first thing you should think about is the performance of your investments, or the lack thereof. Because many of the fastest growing companies, like Amazon, don't pay dividends or pay them in small amounts. It is doubtful that your long-term returns will surpass those of the broader market, such as the S&P 500 index, assuming you don't reinvest your dividends. But even among dividend-paying stocks and ETFs, historical returns have varied greatly. Some of the most well-liked ETFs among dividend investors include VYM, HDV, and VNQ. And whereas VYM has grown by more than 50% over the past 5 years, VNQ has only grown by 13%, and HDV has grown by a similar amount. Now I'd like to talk about a unique ETF that serves as an extreme illustration of this. QYLD is among the highest paying dividend ETFs that has attracted increasing interest from dividend investors. The greatest dividend yield I've ever seen is offered by the Global X Nasdaq 100 Covered Called ETF, which pays out on a monthly basis. Therefore, in our case, $1,200 per month, or 43% less money than the mortgage balance, would be paid to service the mortgage if you invested $123,000 in it. These ETFs do, however, have a significant downside, with QYLD serving as an extreme example. Without taking inflation into account, its returns are down around 11% from the inception date at the end of 2013. Therefore, even if you might receive a sizable income, it's doubtful that your initial investment will grow, and you could even lose some of it. Depending on your objective, you might be happy with that if you really want that monthly dividend. There are undoubtedly investors prepared to make this compromise given the ETF's current net assets of $2.5 billion. Now, QYLD's poor performance is not typical of all covered call ETFs. NUSI, the Nationwide Risk Managed Income ETF, is the following covered call ETF. Moreover, this one enhances QYLD and relates to risk or volatility, which is factor number 2. NUSI has a 2 and a 5-year beta of 0.26, while QYLD has a higher beta of 0.7 and 0.73 respectively. Beta is a common way to quantify risk, Essentially, beta gauges how much the ETF fluctuates over time in comparison to the larger market. An ETF's beta is more than 1 if it swings more than the market, and less than 1 if it swings less. Therefore, the less volatile and riskier anything is, the smaller the beta. NUSI is therefore clearly the less risky ETF when compared to QYLD. QYLD experienced a 24% decline from mid-February to mid-March during the collapse of the common market. NUSI only lost 10% of its value at the same time. What's more, NUSI recovered all of its losses by the middle of April, whereas QYLD is currently about 8% below its pre-COVID high. The trade-off is that NUSI, which is also a monthly paying ETF, only offers a dividend yield of 7.85%, which is still incredibly high compared to an S&P 500 index fund, but not nearly as high as the double-digit return you get with QYLD. It is still not fully recovered more than a year after the crash. NUSI has a 0.68% expense ratio, while QYLD isn't far behind with a 0.6% expense ratio. Even while their expense ratio appears negligible in comparison to the enormous dividends they pay you, it still reduces your return overall, and the cost only increases the longer you hold your investment. Investopedia estimates that an actively managed portfolio should have an expense ratio of between 0.5% and 0.75%. These ETFs, therefore, look acceptable, but I believe another ETF offers a greater value. The JP Morgan Equity Premium Income ETF is known as JEPI. This product has an extremely competitive cost ratio of about 0.35% given what it delivers. However, there are a few more factors that, in my opinion, make this ETF the most well-balanced of the three. First off, its dividend yield is almost comparable to that of NUSI. With no requirement to invest in highly speculative businesses, it now offers a yield of 7.65%, which is extremely high when compared to what you would earn with a standard dividend ETF. Then things get much better. Since its launch in May of 2020, its return has increased by more than 19%, greatly outpacing QYLD and NUSI during the same time frame. Given that it is such and not a predictor of the future, you might be hesitant right now. The ETF's design, however, provides a compelling argument for why it will continue to beat other covered ETFs in the future. JEPI isn't your average exchange-traded fund or ETF. In addition to monthly income, it aims to give a sizable share of the returns linked to the S&P 500 index, but not the index itself. It accomplishes this by building a varied, low-volatility equity portfolio, using a unique research methodology created to find over- and undervalued stocks with favorable risk-return characteristics. This means that it invests in S&P 500 firms that are less volatile than the market as a whole, or even outside the index. There are little over 100 companies, roughly arranged from the fund's lowest holding to its largest share. Many of these are well-known successful businesses, but there are also these odd SPX securities. These so-called equity-linked notes, or ELNs, account for approximately 16% of the ETF and may rise to 20%. They are not stocks of any particular corporation. What are these then? ELNs are derivatives products used to write or sell call options. They were specifically created to integrate the characteristic features of the S&P 500 index. Based on the premium from the call options that ELN writes, they give the fund recurring cash flow. In conclusion, JEPI only sells a portion of its holdings through its ELNs, but QYLD and NUSI sell covered calls on the entire index, meaning that the upside potential for almost 80% of its holdings is unlimited. This does imply, however, that it is more erratic than the NUS side with a beta of 0.43 at 2 and 5-year lookbacks. Additionally, it doesn't purchase put options, increasing its downside risk. However, by focusing on low volatility equities, it mitigates this risk. Given how recent the ETF is, there isn't much different history to consider. A low of 26 cents per share, and a high of 54 cents have been paid out each month. Therefore, if you value having a steady monthly income, this can be a deal breaker. So yes, I believe JEPI is worth serious consideration, since I believe it offers a solid blend of long-term, high-yield capital growth and moderate expenses. We hope this video has enlightened you. So, if you're interested in success in both your work and personal life, don't forget to click the subscribe button, because we will release more videos like this. Thank you for watching. Until then, see you next time.